Hi, I'm Patu from FinCal, and today let's talk about Motilal Oswal Dynamic Fund. This is a dynamic asset allocation fund, so that means that it uses what is known as a Motilal Oswal Value Index, or the MOVI, to determine the equity allocation in the portfolio. This is a proprietary index, which means that they have an arrangement with the NSE to maintain this index, but they do have the historical values available in their website, but they will not tell us how it's exactly calculated. I have done a previous analysis. I've tried to guess how the formula is derived. It's actually based on the 30-day moving average of the Nifty, price to equity, price to book value, and dividend yield, and that's used to determine the asset allocation. So this fund was launched in September 2016. It's not had much of an AUM. It's about 1,200 crores or so. I don't exactly remember the number. I wrote it in the article today. Probably because since that time the market has been up and people don't recognize the value of these kind of hybrid funds until they get hit by risk. So this is a fund that one can consider if they have a mature approach to portfolio management, and for them risk management is more important than rewards. It will not give you it will not try and beat the Nifty 100 or the Nifty 50, but they'll give you a comparable return, slightly lower, but at a significantly lower risk. So that's the kind of fund you can performance that you can expect from this fund. What I don't appreciate is that when you look at the scheme presentation, Motilal Oswal says that this fund market timing is bad, but dynamic asset allocation is all right. I mean, market timing is dynamic asset allocation, and it's a little unfortunate they write something like that. And if you look at the scheme objective, it says it's just to generate long-term capital appreciation, blah blah blah, usual nonsense that's seen in diversified mutual fund. They don't actually step out and say we dynamically change the asset allocation using a proprietary model, and that's the scheme objective, which is very unfortunate. SEBI should take care of that. So yeah, it uses something called the MOVI. I'll show you a picture of that. The minimum direct stock exposure will be 30%, and it can use derivatives or arbitrage opportunities, which will make up for the rest. So the equity exposure will be minimum 65%. So totally equity, including derivatives, will be 65 to 100%. Bonds can be up to 35%. And the rebalancing, this is important. The rebalancing is done twice a month. And I think this is probably the most frequent I've seen. I think other dynamic asset allocations I've seen is only once a month. This is twice a month, which is interesting. It is benchmarked to the CRISIL hybrid fund, which is like 65% of Nifty 50 and 35% of a composite bond index. So this is the actual asset allocation chart. If you notice here, if the MOVI, the Motilal Oswal value index levels is less than 70, the equity exposure is 100%, and then as the level increases, the equity exposure drops down. So higher the MOVI level, more expensive the market, so the equity goes down. So when the market is overvalued, the fund will decrease equity exposure. When the market is undervalued, the fund will increase equity exposure. And it also shows how much of that is actually the details. I'm not going to get into that. So there's a link in the article for this. There's a website called the MOVI Plan Pack. It gives you the data of the MOVI data is available. I used this data to pull out. I pulled out the data. You can download it. You can see the link to Excel here. You can download that, and I try to reverse engineer how it's done. I got close to it, not exactly, but I more or less know how to do it. You can have a look at that article as well if you're interested. So this is the asset allocation. You can see that the the total equity is blue, and out of that blue, this yellow part is the arbitrage opportunities, and then the cash under most of the bonds is in orange and so on. So that's essentially how you can see how it changes the dynamic part here. I think it's basically the direct equity and arbitrage exposure. That's more dynamic than the actual bond exposure so far, at least. So this is a comparison of the index, which is blue, with the CRISIL hybrid index, and you can see that it has underperformed the index for some while, but then it's kind of picked up after the announcement of the SOPs by the corporate tax reduction by the FM, I think. And this is, let me just go push this down so you can see. This is a Nifty 100, which is the green line, and the blue line is the Motilal Dynamic Fund. You can see that this is the kind of performance you should expect. So the Nifty 100 is up. It's a lot more volatile. So this fund will be a lot less volatile, and it will also underperform in the long term. But that's fine. I mean, you will not get too less underperformance, too much of an underperformance. But the risk adjusted return would be decent. That's why I said it's only for investors. Okay, one more. So this is now, in this case, the green is the Franklin Dynamic P fund of fund, which uses the P ratio alone. So compared to a dynamic asset allocation fund which uses P, and the Motilal Oswal uses both P, PV, and dividend yield, you can see that the Motilal fund is a little more volatile than that, than the Franklin fund. At least until the Franklin fund was using the P, it was amazingly good in my opinion, except for the fact that it was a tax like a debt fund. But now they're using a combination of P and PB, so we'll have to relook how that has been going on. But it's okay. I mean, it's not. You should just understand that it's a little more volatile than that. Other than that, I think it's fine. So, like I said, if you are an investor who prefers lower volatility, reasonable returns, not too much return, I think this fund will work for you. I think it's okay to build a portfolio for long term with a core fund as a hybrid fund. It can be an aggressive hybrid fund, it can be a multi-asset fund, it can be a dynamic asset allocation fund, it can be a balanced advantage fund. That can be a core holding, and that will make the whole portfolio less risky, and it's a good option in my opinion. This is one fund to consider. Of course, it's still young. The AUM is not too much, but that can be precisely the reasons why one should invest in it. But it's not for everybody. But it's a fairly good option. Okay, catch you later.